So I just want to take a minute to talk about two of the most commonly used first-time homebuyer programs. I use first-time homebuyer loosely because neither of these programs actually require you to be a first-time homebuyer. But most of the time they're used by first-time homebuyers because they have low down payment requirements, and most of the time first-time homebuyers didn't have 10 or 20% down to put towards the property. So the two loan programs I'm going to be talking about is FHA and the 3% down conventional loan program. Now, I'm going to be talking about a few different major categories. One being the down payment, two being how the credit is viewed for each of the programs. It's different for both of them. Three is going to be the mortgage insurance and how that's structured for each of these. And then how much you can get approved for, which is going to depend on the situation on each one of these. So first, let's talk about the down payment. So FHA has a down payment of 3.5%. Conventional has a down payment of 3%. Now, that can be a little bit deceiving because while conventional technically has a lower down payment requirement of 3%, if you're getting your closing costs paid for by the seller, you can actually end up with less cash out of pocket going with FHA because FHA allows the seller to pay more of the closing costs than the conventional loan program does. If you want to know more information about the details of how much the closing costs can be paid, I have another video about how much cash back you can get from the seller. I'll include the link here so that you can view that. So those are the down payment differences. So to make things simple, if you're buying a $100,000 house, FHA will require you to put $3,500 as your down payment. Conventional will require you to put $3,000 down as your down payment. That does not include closing costs. So things like your taxes and insurance and the state fees and things like that, those things still have to be paid on top of your down payment. You can get the seller to pay those for you, but that's a whole nother story. So now let's talk about credit. Now, credit will usually be the number one thing that differentiates whether you go with FHA or conventional. FHA is more friendly to lower credit scores. So FHA will allow you to go down to a 580 credit score and get a 3.5% down payment. Conventional technically has a 620 credit score requirement, but it never approves a credit score that low at a 620. It's going to require you to be at usually a 680. That give or take whether it'll allow you to do the 3% down. And even then, because of the mortgage insurance, which is what I'm going to get into next, it probably makes more sense to be into the 700s if you're going to do the conventional financing program with the 3% down. So let's talk about mortgage insurance. Mortgage insurance is the monthly fee that you have to pay whenever you put less than 20% down on a home. Now, FHA has a set mortgage insurance. Whether your credit score is a 580 or a 800, you're going to be paying the same mortgage insurance, which is based off of the loan amount. That's good and bad. It's good for if you have a 580 credit score. It's not so good if you have an 800 credit score. With conventional financing, the mortgage insurance is based off your credit score. So the higher your credit score, the lower your mortgage insurance. So if you have a really good credit score, it can make a lot more sense to go with the conventional side of things because your monthly amount that you're paying on your mortgage insurance can be a lot less. If you're at a 680, you're middle of the road, you may have a mortgage insurance that's around the same as FHA. Could be a little bit higher than FHA. So that's something that you'll have to weigh, once you're looking at all your numbers. Now, an important major difference between FHA mortgage insurance and conventional mortgage insurance is that FHA mortgage insurance never goes away. So if you're paying on a 30-year loan, you're going to be paying that mortgage insurance for all 30 years unless you refinance the house into a different type of loan program. With conventional mortgage insurance, the moment that your property increases in value or you pay down that mortgage to where you have 80% or 20% equity in the home, so your loan amount's only 80% of what the house is worth, that mortgage insurance goes away. Which if you're going to be in that house for a full 30 years, that makes a lot of sense. But the thing is, most people who are buying their first house, they're not in it for 30 years. On average, they're in it somewhere between 3 to 7 years. So when thinking about that aspect of it, usually it should fall low on your priorities when determining, okay, am I going to go with a higher mortgage insurance just because it goes away at some point? If you're not going to be in a house long enough for it to go away, there's no point even factoring that in. Lastly, we're going to talk about the approval amount. So when we calculate your income, most of the time, around 50% of your income is the maximum of what you can use towards your total debt, meaning that when you take in that housing payment, your car payment, your student loans, things like that, you can only use about 50% of your income. FHA will sometimes allow you to go above that 50% mark, though, if your credit score is good. So even though most of the time it can make a lot more sense to go with a conventional loan if your credit score is higher. If you're running into a situation where you're having trouble qualifying for the loan because the house is just above where conventional financing will approve you for, it can make sense to go with FHA because FHA will allow you to go up to 57% sometimes. So that was my rant. I just wanted to compare those two loan programs. I will include a link in the description here that'll put some charts in there for you, so it's easy to kind of break out what I just talked about. But those are two of the most commonly used first-time homebuyer programs. Don't forget, USDA is a really awesome first-time homebuyer program. It's one of the only ones that offers 100% financing. But the best loan program, whether it be for a first-time homebuyer or anybody, in my opinion, is the VA loan program. It's 100% financing. There's no mortgage insurance. It offers some of the best flexibility. If you want more information on those loan programs, I cover those programs specifically in a couple of other videos, which I'll link to here. All right, guys, I'll catch you later.